It comes as no secret that I am not a fan of the hedge fund industry. I'm not a fan of it irrespective of the guise it takes on, whether it be superannuation fund, whether it be some sort of managed investment scheme, or perhaps what an American might refer to as a mutual fund, or something more exotic like a hedge fund. And so in this video, I want to look at one particular problem that this industry generates for those who use it. But before I do that, I want to begin with a quote, because this will set the tone of what I'm about to say. And it's also a little bit of a history lesson. And this quote is taken from a speech that was given by Winston Churchill in August 1940 to the British House of Commons. And it was given as the Battle of Britain was approaching its final phase. And the quote reads, "Never before on the field of human conflict was so much owed by so many to so few." And the so few here references are the pilots of the RAF, who day after day after day for that summer in 1940 took off and then tore the German Luftwaffe apart. And so I've bastardised this a little bit to make it more relevant for the funds management industry. And my quote reads, "Never before in the field of human investing was so much paid by so many to so few for so little." And you'll see why that is true in a moment. But what has prompted this and prompted me thinking again about this industry was this particular article on Kerr Nielsen. Nielsen is one of the founders and driving forces behind a group known as Platinum Asset Management. And the article states that Nielsen lost over $500 million in 6 years, then made it all back. And that's a dramatic turnaround. That is a $1 billion turnaround. That is, in anybody's language, very, very serious money. So in the wake of this, I wanted to see how those stakeholders in the Platinum Group have actually fared. And the stakeholders fall into two categories: those who invest in the listed entity, Platinum, and those who give Platinum money to manage. As is my habit, I immediately converted the share price of Platinum into the value of $1 invested. And as you can see, it is less than stellar performance. It is market underperforming performance of quite a dramatic degree. And this comes home when we look at the historical drawdowns, and you can see the history of the movement of Platinum has been one of drawdown. Very rarely has it been a stock that has presented tradable or investable trends. And at present, as of when I snip this particular chart, the historical drawdown from peak for Platinum was 78.89%. So that's how the investing stakeholders are faring. If we look at those who give Platinum money to manage, Platinum divide their results into 10 and 5-year terms, and they have different vehicles in each one. So where a full 10-year was available, I used that. Where a full 5-year was available, I used that. And these are results actually from the Platinum website, with a bit of cutting and pasting and mucking around in Excel to match them up. It's quite easy to see what the performance of the various vehicles is versus their benchmark. You'll notice in this little snip that there are two colours, one blue, one green. Blue is where the benchmark has outperformed its equivalent Platinum fund. Green is where Platinum has outperformed their benchmark. You can see by and large that Platinum underperforms all their benchmarks all the time. There are 3 instances where they don't, but I would suggest that the quanta of difference between Platinum and their benchmark is so small that this may be a statistical aberration. This might just be a fluke. But the one I want to concentrate on for the moment is to look at the Platinum International Technology Fund. It returned, on average, over the 10-year period, 11.1%. The benchmark returned 22%, as measured in Australian dollars. It should come as no surprise to anyone who has even the passing familiarity with markets that there is a preeminent technology index in the world, and that is the NASDAQ 100. And there are a multitude of vehicles to allow you to invest in the NASDAQ 100. As a passive investor, you could simply buy the index via an ETF. And if the Platinum Group had done that, then they probably would have picked a vehicle which is known sometimes as the Cube. The code is QQQ. It's an ETF that matches the NASDAQ 100. Its 10-year on average rate of return per annum is 18.57%. Alternatively, they're a little bit more aggressive. There is a leveraged version of this particular fund which for the same period returned 37.75%. So simply by being a passive investor in an existing vehicle over the preeminent technology index in the world, they could have almost quadrupled their return. To some degree, without wishing to be perhaps too cynical or surly or narky about this, I would have expected a room full of PhDs and MBAs to actually know this, and to know that this vehicle existed and it offered this opportunity. This opportunity to invest in the leveraged version of the Cube was offered to our boardroom members last year. They took it up, ran with it, and subsequently, to use a technical term, have made more money than God. Would any of them get a job at a hedge fund? Certainly not. They're probably overqualified, and they're overqualified for the simple reason that they actually know how to make money, which instantly disqualifies you from working in any form of managed vehicle. I said that Platinum operate funds with 5 and 10-year returns available, and this is simply the 5-year returns. And you can see it's the same pattern. There's nothing different. They fail to meet their benchmarks in the majority of instances. And when looking at this, you might think, well, this might be a uniquely Australian problem. And certainly you could find data that would support that. This is data from the S&P Global Group, and it looks at the number of funds, or the percentage of funds here in Australia, that underperform their index over a series of years. And you can see the broad statement you can make from this is that domestically, the vast majority of funds fail to meet their benchmark over the majority of timeframes, particularly long term. The commonly quoted figure is that over the long term, upwards of 90 to 95% of all investment vehicles offered to the public fail to beat their benchmark. And you might say, well, this might be an Australian problem, simply because the size of our market doesn't permit a very permissive investment strategy. We're somewhat hamstrung in the depth of the market, the opportunities that are on offer. And whilst that sounds logical, it's wrong. And it's wrong simply because the pattern is repeated in the United States, where when we look at the same scorecard applied to US funds, we can see that on average over 20 years, in the low to mid 90% of all funds fail to beat the benchmark, which is an appalling level of performance. When you run a fund, your prime directive, your prime mission is to generate what is known as alpha. Alpha is a measure of skill. And by skill, I mean outperformance of the benchmark. If you are underperforming the benchmark, you're showing no skill, therefore you have no value. So the judgment call you can make on funds both here and in the US is that instead of generating wealth, they actually continue to destroy it on a remarkable basis, which does loop us back to this quote. If someone who is a driving force in one of these funds, and a very, very well-known fund, is capable of generating a $1 billion turnaround in their own wealth, why in the wake of that has that not translated to performance for the stakeholders in these groups? And this is what you find. And this is not unique to Platinum. This is not a unique thing. This is not me simply taking aim at one individual and one company. It's me using that individual and company to highlight a universal problem. So they are somewhat of a catalyst. In many ways, you could say you're the poster child for the underperformance of the industry, yet the ability of those in the industry to make vast sums of money from their underperformance. What is intriguing is if we go back to this US scorecard, people who run funds in all of these categories will, on average, be paid more money in a month than most people earn in a year. And I'm putting aside the multi-billion-dollar salaries that hedge fund managers pull out of their funds. So this raises the question as to why do such funds exist? And I think there is a duality here that has an inherent tension. And I'm perhaps convinced, although not completely, having worked in the industry, that many of the people who start these funds are doing so for the business of wealth creation. But that runs into a tension from 2 points. One, they're not creating any wealth for anybody else. They're creating wealth for themselves. But likewise, I'm quite convinced that many within the industry start these funds to enrich themselves. I'll give you a simple example. If I have a fund with $100 million under management and I charge a 1% management fee, I make $1 million a year. So let's leave aside the complex issue of performance figures. If my marketing team manages to bring in another 100 million, I'm now managing 200 million. I'm now making 2 million a year. I can do that without any change in performance. So by continuing to perform in exactly the same way, I've doubled my income. And I've doubled my income passively because people just keep giving me more money because that's how marketing works. Now imagine we scale that up to someone who has 5, 10, 15 billion under management, but who also builds in some form of management or performance fee for themselves, and you can easily start to see why the people who run these funds are staggeringly wealthy. And this leads me to the point I want to finish on, and it's referring you to 2 books. The first is The Hedge Fund Mirage by Simon Lack. Lack in great detail goes into how hedge funds make their money. Spoiler alert, it's not from trading. The other is a very old classic book by Fred Swed, and he looks at the broking industry, to some degree, the investment management industry, from an historical perspective. And I say historical perspective because the book is older than I am. And he comes to many of the same conclusions generations before anybody else. You'll note these are not books on how to draw trend lines or what is a magic moving average. They're books on the history, philosophy, and psychology of trading, which is where I tend to recommend books. And these two are essential reading, and what they will enable you to do is to understand the industry better. And if you understand the industry better, you understand why you have to avoid it and why you have to learn to think for yourself and take control of what you do. But they will also answer in much more detail and with much more clarity the question of why do such funds exist?